Are you considering a jumbo or non-QM loan? If so, you might have come across something called an interest-only loan. What is it, and is it right for you and your family? Let's break it down. So, an interest-only loan simply allows you to pay just the interest portion of the payment for a set period of time, typically 5 to 10 years, without touching the principal balance. This means you're going to have significantly lower monthly payments during the phase, freeing up cash flow for other investments or other expenses. Once the interest only period ends, payment increases as you begin repaying both principal and interest over the remaining 20 years of the loan. So let's break down an example. Imagine you're taking out $1 million loan at 6.5% interest rate. During the interest only period, your payment's going to be 54.17 per month. Now, normally that payment would be 63.12 a month. And then here's the kicker. After the interest only period ends, typically 10 years, you're going to have a payment of roughly 79.57 if the interest rate doesn't adjust. And typically these are on ARM type loans, so the interest rate can go up or down as the index and margin go up or down, really the index. So what are the pros? Well, and let's see if this works for you. So the initial lower payment is probably the biggest pro. It's ideal for managing cash flow, or if you anticipate your income growing. It makes high value properties a little more affordable to get into. And then typically you're going to have leftover money for other investment opportunities. Now, of course, there are trade-offs. The cons would be no equity growth on the principal reduction during the interest only period of time. So let's say you took out that $1 million loan. After 10 years, it's going to be $1 million. Once the interest only phase ends, you might have what's called payment shock, where your payment jumps up significantly because now we're only amortizing over 20 years versus 30 years. And then lastly, you have some market risk, more so on an interest only loan versus a typical amortized loan, because if the home value declines, then you could end up owing more on the home than what it's worth if you saw a big reduction of prices. So interest only can be a powerful tool. If they're used strategically, they're great for a lot of families, so especially again on the jumbo or non-QM loans. And you just have to plan accordingly and make sure it fits into your long-term goals. If you want to have, if you have any questions, or want to chat, give me a call.